if you could turn a single dollar into $100 in the stock market? Sounds like the stuff of, well, financial fantasies, doesn't it? But let's dive into the real possibilities. Rare? Yes, but possible. If you're turning in now, you're probably keen to get a solid grasp quickly on how wealth can be built in the market. And that's exactly our mission today.
Absolutely. Yeah, we've really dug into the sources to break down this whole idea of 100x return on a stock. Think of this as your kind of express route to understanding the fundamental forces at play.
Right.
We're not, chasing the next hot stock tip here. It's more about understanding the core mechanics, the how and why behind that kind of extraordinary growth when it actually happens.
Exactly. We're going to explore the key ingredients needed for this sort of explosive growth. Things like those exceptional companies, the market's behavior, which can be a bit unpredictable sometimes, the investor mindset, which is critical, and naturally, the risks. There are always risks.
Always.
And stick with us, because we've actually distilled a kind of practical playbook from our material for spotting potential high-growth stocks.
Yeah, a step-by-step guide.
Okay, so let's get into it. What's the absolute foundation, the principle that allows for this kind of massive leap in stock value?
Well, fundamentally, investing in a stock is, it's really a bet on a company's future, its trajectory. For that $1 to, balloon into 100, the company usually needs to go through a pretty significant transformation.
Transformation. How so?
Our sources describe it as a journey, shifting from being, say, a relatively small or maybe undervalued player to becoming a real dominant force in its industry, a powerhouse.
And where do these potentially transformative journeys often start? Are they usually big companies already?
No, not usually. The information we've looked at suggests this kind of dramatic growth is often seen in companies that are still in their early stages. They might be operating in sectors just brimming with potential, high growth areas. Or maybe they're introducing genuinely groundbreaking ideas, stuff that can redefine markets.
So it's really about spotting a potential game changer early on, way before the wider market sees it.
Precisely. Yeah. The underlying logic, according to our sources, it really hinges on a company's ability to seize a unique opportunity. If a smaller company has a truly innovative product or service, and that gets widespread adoption, and it outpaces competitors or even fundamentally changes how we live or work, well, its value can just multiply dramatically.
And the stock price reflects that growing belief.
Exactly. The market's increasing conviction in that potential. So, yes, getting in early before that success is, common knowledge. That's absolutely crucial if you want to potentially achieve those outsized returns.
Okay, so the focus is hunting for these future giants while they're still, relatively speaking, small. Now, our sources talk a lot about disruption and innovation. What role do these concepts really play in getting to that hundredfold growth?
Oh, disruption is pivotal. Absolutely pivotal. Our material defines it as when a company introduces something, a product, a service, even a totally new business model that just fundamentally changes the established order.
Upends things.
Exactly. Think about the examples highlighted in the sources, like a company starting just selling books online
Right.
and ending up revolutionizing global retail. Or, electric cars using software and batteries to completely reshape transport. True disruption creates entirely new value. It's not just small improvements. That seems to be in the DNA of these potential 100x companies.
Right, those are massive shifts. So how does that kind of upheaval translate into a stock price that just goes through the roof?
Well, the reasoning outlined is that disruption fuels exponential growth. It lets a company capture a huge share of a market, and often that market itself is growing rapidly.
Okay.
So this big jump in market share, plus all the excitement around the innovation, that directly pushes the stock price up. For that dollar to become 100, you're essentially looking for a company right on the cusp of that kind of breakthrough when its stock is still, relatively cheap.
It almost sounds like you need a time machine. How can anyone realistically spot those companies so early?
Yeah, it's tough. It demands a mix. Keen insight into emerging trends, definitely. And as the source puts it, the courage to invest before the crowd catches on.
Ah, courage.
Yeah, it means paying close attention to where industries are going and trying to spot the companies leading those changes.
Now, the market isn't just pure logic and numbers, is it? Our sources also bring up market sentiment and momentum. How do these more emotional factors play into this exponential growth?
That's a really critical point. Yeah, the stock market is this fascinating mix of rational analysis and, well, very human emotion. A stock's price can definitely surge just because investors get really optimistic about a company's future, sometimes even way beyond what the company's actually achieved financially at that point.
So hype can drive it.
It can amplify returns, for sure. Positive sentiment helps. But, while sentiment can push prices short term, for that sustained 100x growth, you ultimately need strong fundamentals underneath.
Right.
Separating real potential from just hype. That's key.
Can you maybe give us a quick example? How might that momentum build up?
Okay, sure. Imagine a small, kind of unknown company. It announces a truly revolutionary product.
Okay.
News spreads, media, social media, maybe influential analysts pick it up. This ignites a wave of investor enthusiasm. People start rushing to buy the stock. That demand naturally pushes the price higher.
Right.
Now, if the company keeps delivering, if the product really works, this momentum can build. It attracts even more attention, more capital. It's like, as you said, catching that wave early.
Okay, so it's about getting in when a potential high flyer is still underappreciated before that big wave of optimism hits. But there's a flip side to that, isn't there?
Absolutely. Yeah, the material is clear on that. Sentiment is definitely a double-edged sword. Hype can fade fast. And if a company doesn't live up to those super high expectations, the stock price can crash just as quickly.
Ouch.
Which is why that thorough research into the underlying business, the fundamentals, is just so crucial. You need substance, not just excitement.
That makes total sense.
Yeah.
The higher they climb on hype, the further they can fall. Okay, another key factor our sources highlight is scalability. What exactly makes a business model scalable, and why is that so vital for this kind of massive 100x growth?
Right, scalability. A scalable model is one that lets a company grow really fast, expand operations, reach way more customers without its costs increasing proportionally.
So costs don't explode as they grow.
Exactly. Think about, say, a traditional retail chain. To grow, they need more stores, more staff, more inventory. Costs go up significantly. But a software company, often they can serve millions more users with relatively small extra expense.
I see.
Or online platforms connecting people. They can go global with very little physical infrastructure needed. Scalability isn't just about keeping costs low, though. It's about unlocking that exponential growth because you've sort of decoupled effort from output. That seems to be a core trait of these 100x potentials.
So it's the ability to grow exponentially without the overhead exploding alongside it.
Precisely.
Yeah.
The material really emphasizes that scalability is crucial because it allows a company to potentially dominate its market much faster. When revenue and profits surge because they aren't dragged down by escalating costs, the stock price tends to follow suit, which significantly rewards those early investors.
Makes sense.
The reasoning is basically that a dollar invested in a super scalable business just has a much better shot at generating massive returns because the company has the potential to grow far, far beyond its initial size and create value much faster.
Now, let's talk about the people in charge. Our sources really underscore the impact of visionary leadership. How critical is that piece of the puzzle in this chase for a 100x return?
Oh, it's often the spark. Visionary leadership can be the initial thing that ignites that exceptional growth. These are the leaders who see opportunities others miss. They can articulate really ambitious goals, inspire their teams.
Get people excited?
Exactly. And crucially, navigate the inevitable roadblocks that come up. Visionary leaders don't just dream about the future, they are relentlessly building towards it. And that attracts the talent and the capital needed for that potential 100x journey.
So it's not just about having a great product or service then. The leader matters a lot.
Not at all. The source highlights how, for instance, a really charismatic and forward-thinking founder can pull in critical early investment. They build confidence in the company's future, even when it's still tiny. Ultimately, when you're looking at a potential 100x stock, you're often placing a huge amount of trust in that leadership team's ability to actually execute the plan. You need a capable team to develop great products, build a strong brand, and drive that stock value up.
And the opposite is true. Bad leadership
Can derail even brilliant ideas, absolutely.
Yeah.
So yeah, it's definitely about betting on the jockey, the leadership, as much as the horse, the company idea.
Okay, so we've talked about spotting the right companies, the right leaders. But our sources also really hammer home the importance of patience and a long-term mindset. Why are these qualities so essential for actually realizing those huge returns?
Because achieving a 100-fold return is almost never quick. It just isn't. The material stresses it demands considerable patience. These transformative companies, they need time. Time to refine products, scale up operations, build their customer base.
Overcome problems.
Exactly. Overcome setbacks, challenges, they all face them. And investors who panic and sell during temporary dips in the stock price, they often miss out on the biggest gains later on.
So you have to hold on through the rough patches.
Pretty much. The reasoning is that truly game-changing companies take a significant amount of time to mature. A startup might spend years just perfecting its main product before it really takes off, or a company expanding like crazy might show losses initially.
Right.
But if the underlying direction, the trajectory, is positive, staying invested lets you fully benefit from that long-term success. That long-term mindset is absolutely critical for turning a small initial stake into something substantial.
So it's about having the resilience, the stomach, really, to ride out the inevitable ups and downs, the market wobbles, and the company's growing pains.
Exactly that. Resilience is a good word for it.
Okay, now let's get real about the downsides. Chasing these huge returns sounds exciting, but our sources also spent a lot of time on navigating risks and realities. What are some of the main risks we need to be aware of?
Yeah, it's crucial to be realistic. Pursuing massive returns like this inherently involves significant risk. The material is very clear. The stock market is unpredictable. And the hard truth is, many promising young companies, they just don't ultimately succeed.
Why not? What kind of risks?
Well, there's always the risk of new competitors popping up, consumer tastes changing, or unforeseen external events.
Like what?
Economic downturns, shifts in regulations, global crises, things that can seriously impact a company's growth, even if the company itself is doing well.
And it's not just external stuff, right? Our own behavior as investors can be a risk too.
Absolutely. Investor psychology is a huge factor. The source mentions the danger of chasing hype, buying stocks that are already way overpriced because everyone's talking about them.
FOMO, fear of missing out.
Exactly. And conversely,